everyone, thanks so much for tuning in. This is the Money Show, the only daily show of its kind where we bring you the top financial experts to help answer all your personal finance queries. I'm Avan Dubash with Avni Raja. Hi Avni.
Hi Avan, lots lined up for you, but first the headlines. Well, the Supreme Court has extended the Aadhaar linkage deadline to all services including mobile numbers to March 31st. Order paves way for opening of new bank accounts without immediate disclosure of Aadhaar number, but details to be furnished by March.
Meantime, the winter session begins with the Prime Minister appealing to the opposition for a productive session on key issues. As many as 25 crucial bills, including the FRDI and Prevention of Corruption Bill, will be up for discussion.
And party on the last street as exit polls predict a big win for the BJP in Gujarat and Himachal Pradesh. The Sensex jumps over 330 points in intraday trade on broad-based rally. The Nifty also makes some smart gains led by metals and realty stocks. Mid and small cap counters see some brisk buying. And let's quickly get in. Our guest today joining us is Dhirendra Kumar, CEO of Value Research Online. Thank you very much, Dhirendra, for joining us. Pleasure, as always, to have you on the show. My first question to you is, before we get to all the queries that have been coming in, is with regards to mutual funds and how we've been seeing the kind of where the mutual fund, the asset management companies' interests really lie. Do you see any kind of a trend, especially given the kind of valuations that we are seeing? We're seeing funds, especially small and mid-cap funds, really restricting flows as well. Do you think mutual funds are finding it difficult to find that kind of value in the market today?
Yeah, based on our conversation with the fund managers, we clearly feel that most fund managers agree that this market is not cheap, and at the same time the flow dynamics is extremely favorable and looks sustainable. For the first time, I am witnessing that so many small and mid cap funds have stopped taking lump sum amount one-time investment, though they have continued to take the SIP. Everybody's SIP contracts or mandates are being honored, or those investments are flowing in. It is actually a problem of plenty for them. The market is very shallow. At the same time, it is also the unreasonable expectation of the investor, because everybody is looking at recent past performance and trying to ride it, and fund managers are finding it extremely difficult to deploy that money. And we see that all the funds turning big in a brief period of time are also carrying a lot of cash. They are not fully deployed. Their performance is lagging. As they are within their portfolio, they are actually turning conservative. The positions or the stocks that they are choosing are of not the racy kind. So it is getting difficult. But apart from that, I don't think the other segments, the multi-cap funds or the large cap funds, yes, the market may not be cheap, but I don't think it is unreasonable. That is what the impression that we get. And for investors, it doesn't matter, because if the large part of the small investors' money is flowing by way of SIPs, and it doesn't matter. In fact, if a correction happens, fine. If it doesn't happen, then investors who have carried on with this faith, they are a beneficiary, because for last 1.5 years, the current momentum, the current apprehension about the market valuation has prevailed for nearly 1 year. And if an investor has waited, waited for this correction, it would have been a great missed opportunity.
Okay, that's the outlook coming in. And just talking about the kind of rise that we've seen in terms of individual sectors as well, that mutual funds have been focusing on. Banks continue to remain a big preferential area. IT is a sector that they're putting their money into, along with pharma, engineering, housing finance companies as well have picked up quite a bit of traction of late. But let's get those viewer queries answered as well. Rakesh has connected with us and he's emailed us. He says, I earn 72,000 rupees a month. I am investing in the following funds with a long-term goal of my child's education. Please advise. Well, let's run you through some of the funds that he has in his portfolio. Dhirendra is holding Access Long-Term Fund, Tax Fund, Motilal Oswal Long-Term Tax Fund, Mirae Asset Emerging Mid Cap, and the DSP Small Cap Fund, as well as the Mirae Blue Chip Fund. So just let's get in a view as to how you're looking at these funds. I'm just taking a look at the individual ones, and it's been pretty stellar returns over the long haul. They're investing in some of the key large caps. Can you walk us through each fund and tell us the assessment?
Yeah, Axis Long Term Equity Fund is an outstanding tax saving fund and a fairly mainstream. It is not a small cap, mid cap focused fund. It's a very quality focused fund, and it has done well. And this is the Motilal Oswal Long Term Equity Fund, which is the tax saving fund. These are the two tax saving funds which he has. This is a relatively new fund, 1.5-year old, and the best performing equity fund over this period, or maybe little about 2 years, maybe. But this is something which which will turn out to be a blockbuster, and hopefully it's a focused portfolio. So for the kind of goals he is investing, if your child is too young, very young, and this is for 10-15 years and more, this is a great investment. In fact, many investors look at tax saving fund as a 3-year investment, and then they try and either recycle that money, or they think that the lock-in is over and they need to really pull out. Don't do that. Look at these two funds as your retirement fund, and the other 3 funds are outstanding multi-cap or the small cap fund. Carry on with those for your child's education, or saving for your child, and increase the money. I would say that the kind of investment time frame that you have, resist the temptation to add any more fund than this. 5 fund is good enough. Maybe you should scale down, you should drop one, but your selection is outstanding. I can't think which one.
But Dhiren, let's get in a view as well as to what your outlook is on the Motilal Oswal long-term tax fund, the kind of holdings that it has. How are you looking at this?
I'm extremely optimistic about it, because this is a fund which invests in a very narrow set of, it's not a wide portfolio, broad portfolio. On top of it, because it takes a 3-year view, all tax saving funds have the privilege of getting the money which will not flow out or will not move out definitely for 3 years and maybe more. So given this concentration, given the selection and its growth orientation, because all Motilal equity funds, actively managed equity funds, are intensely focused on growth, and this market has been very favorable. And if you are taking a 5-year, 10-year view, this can turn out to be one of the real dark horse.
Right, Dhirendra. Well, Rakesh, that's the answer coming for you from Dhirendra. Keep to the funds that you have and resist adding any more new funds to your portfolio. Next question comes in from Mahesh, who says, I have invested in 3 mutual funds: Aditya Birla Sun Life, SBI Magnum Multicap Fund, Franklin India Prima Plus. I am trying to accumulate 1 crore within 15 to 20 years. Is this a good profile, or should I make changes and move this around? Dhirendra, what would be your recommendation on each of these funds as well?
No, I could not really pick the Aditya Birla fund, which fund he holds, because Aditya Birla mutual fund has way too many funds. But that apart, I would like to give you a general guideline that 1 crore, having 1 crore is a function of time and the amount of money that you invest. Without these two things, if you put 50 lakh and you are expecting 50 lakh rupees to turn into a crore in 5-6 years time, I think it is a reasonable expectation. If this is a 10-15 year goal, then it is entirely a matter of how much money are you investing. Be more conservative with your expectation, and it is better to get surprised with those with superior performance than be disappointed with a very exaggerated expectation. So I would say that it's a function of amount of money that you invest and the time frame for which you will be investing. These funds are good. The 2 funds which I could figure out, be regular with it, and try and manage the controllables. You have control only on 2-3 things, which is you will choose a diversified fund, you will be regular with your investing, and you will increase the amount of investments as and when your income rises. If you do these 3 things, the magic can the magic number can be achieved more in a more predictable way, because even if you start with 10,000 rupees and you increase it by 10% a year, the accumulation of your money will be substantially higher than if you keep it constant.
Okay, I hope you've taken note of Dhirendra's advice on the individual funds that you hold as well as his outlook going forward. Moving on from one query to another, and this is a sort of a general query when it comes to investing in mutual funds. What should be the outlook? So, Dhirendra, I would like to get in your opinion. Animesh is connected with us on Invol. Now, he says, what should be the ideal mix of large cap, mid cap and balanced funds in his portfolio? He's looking for a fairly long-term time frame for retirement over the next 25 years or so. And ideally, I'm sure anyone who's putting their money into mutual funds would like to know how exactly they can maximize their returns in terms of diversification or allocation to different types of funds. So when it comes to large caps, mid caps, what exactly would you advocate?
I would advocate that, generally speaking, the reflection of accumulating your investments, savings into investments for retirement, which is 25 years away, you should be as much into equity, create your term, buy your term plan, get your health insurance, create your emergency fund, and after that, put as much money in equity as possible and invest as regularly, be with a diversified vehicle. There is no role for a balanced fund here unless you are getting started and you are extremely nervous about the state of the market. So, maybe that is a good starting point, it is a good starter way strategy, but after 2-3 years you must switch to an all equity portfolio and you should turn conservative as you get closer to your goals. So, maybe 5 years away from retirement, maybe you have a 30% allocation to fixed income. That also depends that what is going to be your income requirement from your investments accumulated. So, you have to work on a very simple plan, have your term plan, have your health insurance and invest, have your emergency fund and invest in equity as much as possible for a goal which is 25 years away, invest regularly, be with diversified funds.
Right. Animesh, that's the answer that you were looking for as far as your retirement portfolio is concerned. And sure, Dhirendra's comments will also help all of you who are still looking to how to plan your retirement portfolio as well. But on that note, let's slip into a quick break. We'll continue taking up more of your queries on the other side. Meanwhile, keep all your questions coming in on The Money Show.
Hi there everyone, welcome back. This is The Money Show. We're in conversation with Dhirendra Kumar of Value Research, addressing all of the questions and queries in the personal finance space that you have sent us in. Well, let's move on and focus in on the next query for the day. And Divakar Roy has connected with us. Well, he says, I'm a regular investor in mutual funds and I need the money back in 6 to 12 months. So he asks, what's a good time to redeem my money and where can I reinvest it if I look to redeem it today? Is there any sort of a rule of thumb, Dhiren, as to at what is an appropriate time frame at the minimum to put your money into mutual funds? He perhaps needs this on an urgent basis. And what's a good avenue for Divakar to reinvest?
There are very simple, straightforward, things which you should consider. It is actually, that is the first step of investing, that you should choose the right vehicle for given the time frame. If you are not investing for 5 years and more, you should not even think of equity. If you are thinking of, 1 year, 6 months to 1 year, and that too for a non-negotiable goal, then your options are very limited. You should consider only the liquid funds or the short-term bond funds. Look no further, because this will ensure that, because in the short run, the market could be very unpredictable. You can lose a lot of money if you are dabbling in equity for this time frame. Equity becomes relatively safe when you think of, investing for many years and when you are able to average it. So accumulating your savings into investments, into equity investment is the best way for common investors to approach it. So your options are limited. Consider only short-term debt fund if your time frame is 6 to 12 months. Now comes, the question, when you need the money, you have accumulated your savings in equity and you are likely to need in 1 year's time. The simple strategy is that the way you do your SIP, exactly the way you should do a periodic withdrawal, because you should not be dependent on the state of the market for taking your money out. So as you are gradually accumulating your investments into equity, to average it, you should average the withdrawal as well and park that money into a liquid fund or a short-term debt fund because that is the only way you will be able to insulate your investment from the wildness of the market.
Well, that was as far as Divakar's question was concerned. Hope you've got the answer that you were looking for. Avoid trying to time the market. That's really one of the most important takeaways as far as investments are concerned. Our next query comes in from Mrs. Suresh from Delhi, who says, I have an SIP in HDFC Tax Saver and SPI Magnum Equity Fund for 1.5 years. What's your view on these funds? And I also have an additional 5,000 rupees to invest per month in mutual funds. What funds would you suggest? Dhiren, as far as both these funds are concerned, and also if she has additional, should she top up her existing funds or perhaps opt for another fund altogether?
Both are proving to be, a decent fund. They are all both diversified vehicle, don't need to, and both managed by different fund managers with reasonably different strategy. And both are credible performers. One is a tax saving fund, so your money gets locked in for 3 years, and if that is a need, then carry on with that and invest more money in the second fund. I don't think you need to add third. You are getting, and make sure that you are only doing SIP and for with a 5-year time frame and more.
Okay, thanks very much then, Dhiren, for joining in. I hope you've taken note, all of the viewers who sent in your questions and queries for Dhirendra Kumar. He's really helped us out with the personal finance questions. Well, as we wrap it up on the Money Show and as we gear up for the state elections, let's hear it from a big market voice. Neelkant Mishra of Credit Suisse says most outcomes seem to be priced into the markets. Here he is in conversation with Ajay Sharma, saying that the GST rate cuts in the budget will be the fastest way to stimulate the economy.
From a pure economic perspective, I think once the budget is presented on 1st of February, I don't see that big an impact, right? Because the point is, you will see changes happening around GST. So as the government gets comfort around the fiscal arithmetic of GST, and they can extrapolate the first 4 months of revenue to the full year or not, or as compliance goes up, or as say next year, hopefully with e-way bill and all the invoice matching, hopefully revenues will start picking up. But it is possible that they could cut rates on many categories. That's the fastest way to stimulate an economy, right? Any other stimulus is far too slow acting, because if you push money from the top, for it to come out and start affecting the lives of people, the incomes and the expenditure of people, is actually going to take a while. And therefore, my sense is post-budget, there is not direct economic implication, not too much of it anyway. But from a market perspective, given that everyone in the market seemed to be 100% certain that 2019 we will not see a regime change. So the point is, even if you are 100% certain about something, as you start coming closer to the date, the exam blues, and as state elections start happening, people will start reading the tea leaves of are things changing, are things not changing. There's Karnataka, which is a big state in April, May. And then there is the semi-final elections of Rajasthan, MP and Chhattisgarh in November, December. And let's see what happens on the 18th. But the point is that the market will become a lot more sensitive